Imagine a multi-trillion-dollar financial sector operating without a permanent legal map. That is the current reality of the cryptocurrency market in the United States. It's massive, it moves fast, and it exists entirely within a precarious legal gray area. Traditional financial markets run on predictability. To thrive and attract serious institutional capital, a market requires the bedrock of clear legislative boundaries. Investors need to know exactly what the rules are before they commit billions. Enter the Clarity Act. Congress drafted this bill as its master blueprint, Plan A, designed to finally solve this regulatory ambiguity and draw definitive lines in the sand. Without a unified legal framework, those trillions of dollars remain exposed to sudden bursts of regulatory chaos and unpredictable enforcement actions that can wipe out value overnight. The core function of the Clarity Act is jurisdictional. It aims to remove most digital tokens from the reach of the Securities and Exchange Commission, handing exclusive oversight of digital commodities to the Commodity Futures Trading Commission, or CFTC. Initially, the bill had significant momentum. It passed the House with a strong 294 to 134 vote and successfully cleared the Senate Banking Committee. Then it hit a roadblock in the Senate. Senate Democrats objected to the proposed ethics provisions, the rules meant to govern government officials' personal cryptocurrency dealings, arguing they were too loose. Adding to the friction is an unresolved dispute over whether stablecoins, tokens pegged to fiat currencies like the US dollar, should legally be allowed to pay out yield to holders. These disagreements have effectively shelved the bill ahead of the Senate's August recess. In a fractured Senate, this legislative gridlock paralyzes industry innovation and forces federal agencies to prepare emergency interventions to fill the growing regulatory vacuum. SEC Chairman Paul Atkins has made his position explicit. If Congress fails to pass the Clarity Act, his agency is ready, willing, and able to write the rules themselves. This marks a clear strategic shift. Rather than waiting indefinitely for a divided Congress, the SEC is preparing to rely on immediate administrative rulemaking. They call it Project Crypto, or the Regulation Crypto Rulemaking Package. Placed on the agency's 2026 agenda, it serves as a comprehensive agency-level regulatory safety net. Project Crypto is not the ideal permanent solution. It's a necessary immediate bridge preventing market deterioration while lawmakers continue to debate. The first pillar establishes distinct token registration exemptions, outlining exactly which digital assets qualify to bypass standard requirements. Then, a safe harbor provision creates a temporary shield for new, decentralizing projects against enforcement actions while they build their networks. The package also establishes strict operational rules, detailing exactly how broker-dealers must handle custody of these assets, alongside specialized oversight protocols for crypto trading venues. The groundwork for this approach is already laid. In March, the SEC and CFTC issued joint administrative guidance, officially classifying 16 specific tokens as digital commodities rather than securities. Crucially, the market's two largest assets, Bitcoin and Ethereum, were explicitly included in this digital commodity classification. Through these specific mechanisms, Plan B successfully builds a functional regulatory machine, one that operates entirely without a single congressional vote. However, as Chairman Atkins himself admits, Plan B has a structural, fatal flaw. These SEC rules are merely administrative directives, not statutory law. This is a critical difference in legal power. Administrative guidance is fragile. It can be entirely withdrawn or rewritten by a future presidential administration with the stroke of a pen. A congressional statute, by contrast, offers absolute legal certainty. Passing a bill like the Clarity Act is required to truly protect the industry against shifting political winds. A multi-trillion-dollar framework built exclusively on easily reversible administrative guidance is inherently unstable. It cannot provide the concrete assurances needed for long-term institutional capital investment. The SEC has successfully deployed a complex stopgap measure, but it is only a temporary patch on a systemic problem. Financial regulators, regardless of their operational readiness, cannot permanently resolve a jurisdictional crisis. That level of authority explicitly requires a legislative mandate. The ultimate resolution for the American crypto market rests entirely on the fractured Senate and their ability to forge a compromise after returning from their August recess. Until Congress acts, the American crypto market remains precariously built on shifting political sands, leaving its long-term survival hanging in the balance.